Hi, my name is Martin Schenkman, and I'm joined today by Jonathan Blotmacher, and our topic for this video clip are note sale transactions. Jonathan, do you want to give a little explanation of what a note sale transaction is, and then we can banter about it for a few minutes?
Yeah, there's a fairly long history of note sale transactions. The other name for those are installment sales to grantor trusts. The IRS in 1985 came out with just an absolutely extremely important revenue ruling for estate planners, which is that a grantor trust does not exist for income tax purposes. That's right.
I'm smiling because I remember you lecturing somewhere saying that you had a tattoo the ruling number.
Marty, what I do when I lecture on this, I bring lots of white gerbils. And I tell people that everyone is going to live with a white gerbil, but they shouldn't take it to their office. They should take it to one of the fine tattoo parlors in their community and have revenue ruling 85-13.
Want to say that one more time?
85-13.
That gets tattooed on
which
body part of the gerbil?
Well, I think it's on the side. So when you come home and you begin to pet your gerbil, which you'll do every day because they're such loving creatures, you will see 85-13. And what's also key is when your gerbil dies, you will take it to a taxidermist, and you'll have the hide done. That's right, taxidermist. And you'll have the hide, which you can then put on your door. So every time you go through that door, you will see the hide with 85-13 tattooed on its side.
And back to note sale.
The key here is the following. If you want to get an asset out of your estate, generally you have to give it away. But one of the things you could do in lieu of that is to sell it for its full value. And if the asset is appreciated, obviously you'd have gain. But because of 85-13, when you sell something to a grantor trust or buy something back from a grantor trust, it's not treated as a transaction for income tax purposes. So let's say you own a shopping center through a limited partnership. You sell the limited partnership units to the grantor trust for full value. And we'll get into some discussions in another clip as to how you can kind of hedge if you're not exactly positive what the value is. In any event, you get back a note, and that note only has to bear the very, very low AFR, federal applicable rate, interest set forth in 1274D of the Internal Revenue Code. And that won't be a gift. So, for example, today the midterm AFR is about 2%. So you could sell this shopping center interest to the trust for a note equal to its appraised value, and you'd get a note that would bear interest at only about 2%. And by the way, if you do it correctly, the interest can accrue. And what you hope is that the value of what you've sold will increase at a rate faster than the interest on the note. In addition, at least under today's law, if you sell a partial interest of what you own in the shopping center, like you only sell limited partnership units, there may be a discount in value. Now, that discount in value is the real value of the product of what you sold. But what the family is getting is probably worth more to the family than it is to a stranger. So you get two immediate benefits. Number one, you get it out of your estate at a fixed value, which is only going to grow at the AFR interest. And number two, you may have captured a discount in valuation. That can be extremely important to do. Marty, you have any additional thoughts about it?
Let's put a little bit of framework on the relevance and use of note sales in the current environment. So right now today the estate and gift and GST exemptions are 11.18 million. So for the majority of Americans, there's no need to do a complex transaction. They can give assets to a trust, get them out of their estate. You and I have done some other video clips on basic planning to use exemption. But for wealthier taxpayers, now is a critical time to look at this, because if there's a change in the administration in Washington in 2020, there could be a range of restrictions put on this kind of planning. So I'm seeing, and I'm curious if you are, a surge of very wealthy clients trying very hard to conclude these transactions before, let's say, 2020 election, and before there's a change in these rules to shift significant wealth out of their estate. Lock in the discount. The trust is a grantor trust. so that there's tax burn on the asset. They can swap assets back into their estate to get a basis step up.
By tax burn, Marty, you mean the fact that this asset sold may produce taxable income, but because it's held by a grantor trust, the trust doesn't have to pay the income tax on that income. That's shifted over to the grantor. And I once did a study with some other people comparing installment sales or note sales to grantor retained annuity trust to just straight gifts out and which was best. And what it turned out, the installment sale to the grantor trust or the note sale was best. But the most important factor in reducing the amount which ultimately would be taxed to the family was grantor trust status, so you had that tax burn.
It's interesting because many people get fixated on the discounts when in fact it's the tax burn and in some cases the significant appreciation post-transfer that could be quite important. Any other comments on what you're seeing people do now and why?
Well, one of the reasons that even someone who is not as super wealthy as other people are is, again, there could be a change in the law. And number two, you now get the asset basically in a structure where it will be more asset protected. You make a sale of an asset to a trust in which you don't have an interest or your creditors can't attach it. You're doing it for independent estate tax planning purposes. It's frozen in value. If someone even came in and tried to attach it again, it's going to have de minimis value probably to your creditor. In fact, there are some other things you can do. So that's really something that people want to consider. And that differential in how much is available to the family and what's available to you. And unlike someone who, say, has $100 million who can afford to give up 10 or 20 million of his or her wealth, if you only have, say, $8 million, you might say, but I'm willing to do this because I think the law may change, I want to freeze value. But what about me? What do I do? Well, because you have this note, you can get payments. And as a consequence, it's not like you've given it away and can never benefit from it. You don't have to put it into something like a self-settled trust where maybe you could get a benefit. But you're going to get benefits from this property for as long as the note is outstanding.
And it's not just the interest payments, but if you need principal, you may be able to call the principal depending on the note is structured.
That's right. Or the trustee can voluntarily pay you principal.
There's legend that you should have a 10% seed gift in the trust. So and different people do the math differently, a ratio of 10 to 1, 9 to 1, but that if you're selling $10 million, you should have $1 million in the trust. Any thoughts on this concept of a seed gift or adequate capitalization of a trust?
Well, this came about kind of indirectly when I first came up with this idea and disclosed it to one of the largest accounting firms in the country, which promised me they would tell no one about it. They called the IRS. And they then came to me and said, we call the IRS. And I almost choked the guy who told me this, but he said, we have good news. The IRS has no problem with installment sales to grantor trust, provided there's at least 10% equity.
But
so
that's just hearsay.
That's hearsay. That's lore, not law. But the bottom line is you want the transaction to look basically commercially reasonable. Now, again, if I have a $100 million building and I sell it to the trust, very often you can buy buildings with no money down, as the ads on TV say. Yes. So whether it has to be 10% or 5% or whatever, I don't really think that's a hard and fast rule. The only thing is it's kind of what the community now does. So if you can possibly get at least 10% in, again, Marty, whether that means 1 to 10 or 1 to 9, we can debate that. But if you can do it that way, you're kind of putting yourself in less vulnerable ground for someone from the IRS to come in and attack it.
I think it's a good point to make because I've heard people lecture as if this is law, not lore. But I like the phrase that it's lore, not law. Another point that if you don't have the wherewithal to get the funds into the trust, you may be able to use guarantees and other structures. I think we should wrap this up. There's going to be some other
Let me add one other thing that I did. One of the things I did was I had the client create 2 trusts. One that was going to be the trust that would buy the asset from the client, and the other one was a trust he had created. It was a man who did this, who created it for his wife, and that went into a standard general power of appointment lifetime marital trust. And what we did is we had the marital trust loan the money to the trust that bought it. So there was never any indebtedness between the client and the trust that made the purchase. So people who worry about, are you retaining an interest because you're going to get payments from the trust, that's gone. So if there is enough available, you could create two trusts. One, a grantor trust, which is going to buy the asset from the client, but second, a non-Q-tip. You don't want a Q-tip trust because of that very onerous section 2519, but make it a general power of appointment, marital deduction trust, fund it with a cash, wait a respectable period of time, and then that marital trust, which is also a grantor trust, can loan it over to the grantor trust, which is going to buy the asset from the client.
We have to wrap up. This video is for educational purposes only. We are not giving any legal or tax advice.
Absolutely not.
Thank you for joining us.